Boom, we're live. Hello, everyone. This is Thursday on the Block with Blockchain Center. I'm Zenia Vazimskaya. I'm hosting some Thursdays, and today we're jumping into part 2 of our discussion that we started last week about digital assets and institutional grade digital assets for high net worth individuals, family offices. And today I'm really excited to continue this discussion and dive deeper into specific products, regulations, and other matters related to this topic. And today we have amazing speakers, Dr. Mark Fleury from 2Prime. Hi, Mark.
Hello.
Trent Barnes from XEROCAP.
Hey, guys and girls.
And JJ Peterson from Binance Korea. Hi, JJ. Thank you so much for joining us today. And I would like to start by asking you to tell us a couple of words about yourself and your work in the space, starting from Mark.
Sure. My name is Mark Fleury. I actually have a background in open source software. I was the founder of one of the first professional open source companies, sold that to Red Hat in 2006, and basically retired doing physics and music most of the time. But as an investment, I got into Bitcoin, or discovered Bitcoin in 2011 through the original team asking for help on the open source aspects of Bitcoin, and I knew more monetary theory than is recommended for most humans, and so studied Bitcoin from that angle in banking theory, etc. Came to the conclusion it was not a currency, but it would be a great and fantastic investment vehicle, and that has come to be. Today, I'm here as 2Prime, and what we do is basically, as a high net worth individual, how do you invest in the space? It's difficult. I mean, of course, you can go to Binance, you can go to Coinbase, but if you want to do something a little more elaborate, how does that happen? How does the liquidity happen? There's specific needs for high net worth individuals and how they invest in them. There's also different expectations. They're familiar with equity, they're familiar with debt, but not necessarily with crypto. And so we're trying to bridge those two worlds and bring sort of new participants and new liquidity to the crypto. I don't want to call it a ghetto, but there's certainly a very deep flavor to our industry. And so I'm proud to be part of this professionalization movement, which we've seen in the open source case and we're seeing now in crypto. And that's it about me.
Thank you, Mark. Trent.
So good morning, good evening, everyone. Trent here from XEROCAP. So one of the principals here and also the head of client relations. Essentially, XEROCAP provides digital asset trading, insured custody, and yield products to high net worths and emergent wealth and family offices globally. Essentially, what you could say our mantra is zero friction, borderless finance. And I guess one of the key aims is just to remove legacy frictions within traditional finance and provide unique sort of benefits to traditional portfolios. And we just had a report released yesterday, so I can also make that available on Twitter and also in the chat as well, which is diversifying portfolios to balance them out with Bitcoin. So yeah. In terms of personally, love adventure, skydiving, rock climbing, surfing, and that's what I do outside of this, and that's me.
Thank you. And last but not least, JJ, please tell us a couple of words about yourself.
Hey guys, got into crypto in 2017, arbitraging the Korean markets. We turned that into creating a Korean won stable token, which we ended up exiting to Binance and then partnering to create Binance Korea. My background is in wealth management, and I've also been running kind of like a private hedge fund just this whole time as well on the side. So probably a lot of my relevant experience for this conversation is more on the trading side and my own personal trading.
Got it. Thank you. And let's start with definitions. When we talk about digital asset, what makes digital assets institutional grade? What exactly are we talking about here? Mark, would you like to start?
Sure. What makes a digital asset institutional grade? Let's start with the fact that investing in Bitcoin is difficult for most institutional investors. It's a very regulated industry in the United States, and around the world there's really standards you have to go by. I mean, it gets boring arcana to be boring arcana, but things like accounting, who's your lawyer, who's the custodian, how does the redemption window work, how does the liquidity work, does your reporting get up to snuff? And you have to bench that with the ICO phenomenon of 2017, which was, woohoo, give me some money, and that was it. And so as an institutional investor, even for somebody comfortable with tech like I am, figuring out the key, the custodianship, and all of that can be a big headache. So when you address institutional or high net worth individuals that are not at the forefront of investing in crypto, because you certainly have high net worth individuals in crypto, but for the masses, it's difficult. And if you look at the United States, there's very few products out there that are traded as stocks. There are a few that are listed in the public markets, but if you have a 401k and you want to invest in Bitcoin, you got to do your due diligence of going to an exchange, and then your interface is that of an exchange, etc. And so really, in essence, there's two things, and I'll stop and pass the buck along, but definitely investing in crypto is on everybody's mind who's high net worth, because of things I'm sure we'll discuss on this panel. If anything, as an inflation hedge or a diversified allocation. And so the question on most people's mind is not if to invest in crypto, it's how to invest in crypto. And how to invest in crypto means you have to translate what we do in crypto, which can be daunting for most people. The technicalities of what we're doing is enough to put off anyone. And you have to map to the language family office and traditional investors speak. And when you look at term sheets or SPV vehicles, there's a laundry list of checks that you have to go through. You have to be audited, you have to report, you have to declare your windows, you have to speak the language of the family offices. And so to a certain extent, it's a linguistic exercise to take all the cowboy bullshit we do in crypto and put it in a package that is not off-putting and scary to your average to your accredited investor in the US or sophisticated investor all over the world, really. Asia and Europe are huge participants in this. So that's it. That's my take on how it's mostly how do you make crypto institutional grade, and that's where I think that there's a lot of work being done right now.
Thank you, Mark. Trent, JJ, would you like to add something to what Mark just said?
Yeah, I mean, I would go for it.
Go, JJ.
All right, I would just echo. It's really about the comfortability. I would say when you think about something being institutional grade, it just has to be something that is familiar to what currently exists and is comfortable to those utilizing the products. And that's really, it boils down to being as simple as that. There is a way that everything is currently done, that everyone's used to doing it. It's just matching that standard.
Mm-hmm. Definitely. Yeah. And I think Mark touched also upon a very interesting topic, like several questions, but my question for Trent would be, but why in the first place would high net worth individuals and family office want to invest in digital asset? Would you like to maybe cover that as well?
Yeah, no, definitely. And I'll just add on just a little bit to what Mark and JJ said. I think, that comfortability is certainly important. And, in terms of speaking to some of our clients that got in 2017, didn't understand custody, just as Mark was saying as well. And even having been scammed and downloading a wallet that was I guess run by some scammers, and then plugged in their Trezors and then transferred their assets across. So I think, for them, it definitely comes down to, a couple of years ago, there was a few family offices that got burnt. But if we're talking about, real institutional grade, which, family offices definitely fall into, we're talking probably like deepening pools of liquidity for your trade executions, so that if they wanted to execute across or on an exchange, then it's just going to be hard to be able to fill the orders, particularly if you're buying at the same amounts as MicroStrategy was, which is 425 million in the last few months. The counterparty protections, storage and custody, security, the insurances, but also regulated derivatives as well, and sort of new access vehicles to credit markets. And of course, the regulatory framework as well. And I guess when they feel safe around that, because whenever you have a new digital asset and a new asset class, that's some of the things that they're looking towards. And then, why would they want to add digital assets into that? I think, the current economic climate at the moment is certainly, we are seeing a large uptick in the amount of traditional investors, family offices, high net worths, that are looking to essentially look for, as Mark mentioned before, like a safe haven, like a move into a safe haven asset, which gold and precious metals have traditionally been. And I think the traditional market's starting to look now towards digital assets. And as I mentioned before, with MicroStrategy, taking cash off the balance sheet and just putting it towards Bitcoin, that sort of confidence echoes throughout the market. And, one of the interesting things that happened with one of the announcements from the SEC, they apparently want to increase the reportable threshold that institutional investors need to report on their investments from 100 million to 3.5 billion. So the market will lose, quite a lot of valuable transparency over sort of the institutional engagement in crypto and digital assets. Because if we look at Grayscale's fund, for instance, will basically have a list of all the institutions that are invested in. So you have ARK Invest that has been in there since 2015 or 2016 or something like that. So I think that, why would they want to invest in now? Certainly the answers for me, just to succinctly sum it up, would be, cash is devaluing, losing its value, and will continue to. The Fed's come out talking about doubling inflation. And so there's just a real, they've put a real scare into the market, not to mention just the stimulus in QE. So Bitcoin certainly, has always been referenced as digital gold, and I think it's starting to be treated like that more tangibly now. The more education that gets out to traditional investors, the more that they'll come into the space. So, yeah.
Thank you, Trent. And if we start to get into more specific, like we defined the area, but if we're talking about the specific products, high, like institutional grade products in the digital asset space, what are the things we're talking about? Maybe name a few. Again, maybe Mark, would you like to start? Because Mark is the first one on my screen.
Sure, I'll start. What are institutional grade products on the market related to Bitcoin? There's very few. The one that comes to mind that has done things right is definitely Grayscale and the Grayscale Bitcoin Trust. Now, what's interesting when you look at the paper, and I do as an investor, we're investing in Grayscale. But you have to understand the mechanics that it's really, you have a secondary market with a paper called Bitcoin. It pulls the same linguistic trick that Doge does, meaning there's nothing Bitcoin about it, namely you have no redemption window. So the only redemption you have on Grayscale is actually its secondary. That's a very interesting proposition because it gives rise to a whole cottage of distributors that basically arbitrage the discount to the primary, from the primary to the secondary. So if the primary is trading at 80% from the secondary, you have pushers for the product essentially. So to answer your question, there are not many institutional grade products ready, consumable as, I like to talk about an impedance mismatch, to use a physics analogy. We touched a little bit about how do you get that comfort, and to get the comfort or comfortability, you have to speak the language of the people in front. And so Grayscale has done something very smart. They're listed on the stock exchange, or a version of the stock exchange, through that OTC trading software thing. They're one of the few that have pulled that trick, but even people in Merrill Lynch cannot pull the trigger on buying Grayscale for their 401ks because they're actually blacklisted. And so there's few. To echo what was said, there is an intent to invest. People want to invest because people naturally recognize the attractive aspects of the technical trading of digital currencies, namely numerus clausus, finite numbers, thinly traded order books on the exchanges, which make them very susceptible to incoming flows. I mean, Bitcoin, for every dollar entering, you have a 40-60 multiplier from cash to equity. That's a remarkable multiplier in the market. And so as an inflation hedge, it's beyond gold. And so how do you grab a hold of that? All right, well, so you go to an exchange where you really have, some flow. There is some real liquidity today in the markets. But an investor is going to care. As an investor, I care about a few things. Is if I give you my money, how do I take it out? To put it very simply. And so it's all about the redemption. So that's why I led with Grayscale. Grayscale has no direct redemption to the fucking trust, pardon my French. So you put money in, but you can never take it out. And you got to go to the secondary. This is the very definition of a smart Ponzi, where your liquidity is limited to the secondary market. So you got to have somebody to buy your shares. The trust is not buying back the shares, ever. It's not in their papers. End of story. And so as an investor, I look at the paper and I go, so I give you money, but I'm never taking it out except the secondary. Well, that's a difficult proposition. And it has nothing to do with Bitcoin except the fact that the trust is sitting on a lot of Bitcoin. Really what you're trading is the attraction of Bitcoin in the secondary market. And the fact that they have the Bitcoin trust in their word gives them the traffic. But it's not a crypto product. It's a paper you call Bitcoin and happens to be traded and happens to buy Bitcoin as a trust. Good for them. So I think there's a lot of room for improvement. Also, when we look at Coinbase, or not to knock on you guys, au contraire, but most investors don't want to have a trader view of what's going on because they're not trading. In fact, they don't want to trade. They want to put the product and fuck off, which is which people do. And so, you don't want to deal with the trading view and placing. Some people do, most people don't want to. And so the product is not the exchange, even though it's the exchange that makes this real. Both the exchanges and the OTC and all the liquidity pools that exist today in crypto that are real mean that an institutional investor can come in and have some confidence that they'll be able to take their money out when the time comes. That kind of product is really very important. In fact, the birth of banking, now I'll finish with that, was dépôt à vue, which is still practiced in Switzerland, which means I give you money and I can claim it at any time. And if you think about debt, it's all about the transformation of I can only claim at the time the debt is done, at term. So this continuous liquidity is actually very attractive. I think it's mature in crypto. And what you see around the markets are really participants that know how to take advantage of those various liquidity pools, be it high net worth individuals, exchanges that are sitting on vast amounts of liquidity in and out. And all of that is getting solid, and the products are appearing. And not to do a commercial, but 2Prime is one of those agents. We market the FF1 token as a stable growth entry point to these markets.
Thank you, Mark. And to what you just said, it will be very interesting to know JJ's perspective, because like Mark just said, investors are not really interested. They're not involved from the trading side. So how does it look from your experience, and what do this type of investors should actually be paying attention to?
Yeah, I mean, it's interesting coming from the trading side and having a trading background, right? I think right now, personally, there's a lot of alpha to be had in the market because there's a lot of people in this market right now who are just simply not traders. And it's because there is no easy way for any of the actual good traders out there to just come in and enter the space without having to go through the entire education process of getting up to speed with crypto. I mean, like, I guess I'll just kind of share this. Personally, with my own fund, I custody on exchange. And I think a lot of people find that super interesting. But I have yet to find a custody solution out there that is really that different in terms of a risk perspective than just custodying on exchange. I mean, effectively, the technology they use to lock the assets is nearly identical. The self-insurance fund of most of the exchanges is actually pretty large and would be significantly cheaper than if you're actually paying for insurance in another location. So if you're willing to go through the hurdles to actually get kind of caught up to speed, it's user-friendly enough. But once again, if that is not your background, then there's really no easy way to get in and out. And we have an entire tech team that we have that integrates us into exchanges that allows us to plug into APIs, to place orders, to smart route orders, and to do things that a standard person who's logging in and just clicking is not really going to be able to do. So right there's just a really long way to go before anyone at JP Morgan or Morgan Stanley is going to be able to do anything on behalf of their books or on behalf of their clients.
Thank you. And I'll slowly be starting to read some comments for the audience. And this one is relevant. It's a question for Trent. Trent, besides Bitcoin, which digital assets are your client asking you about the most? So it will be really interesting to learn because we mostly mentioned Bitcoin, but certainly there must be something else. So yeah, that is the question.
Yeah, definitely Ethereum. That's certainly been an investment case that, particularly over the last 3 to 4 months, that our clients have started to ask a lot more about. When you look at the DeFi space and the rise of DeFi and the amount of projects, and regardless of whatever project you get involved in, the underlying protocol is Ethereum. And with Ethereum 2.0 coming up as well, it's and I guess the whole education piece from our end to, let's say, traditional investors that they may not know the space, it's a little bit more challenging to be able to talk about one, Bitcoin, and then two, the whole notion of smart contracts, a whole protocol layer with a whole bunch of different project or DeFi projects on top. But so Ethereum, there's been an interest within digital gold as well, not the moniker of Bitcoin, but products like PaxG or Pax Gold. And I'd say the last one where we probably get the most interest, and that's to do with lending markets, would be US dollar tether. So they're the ones that our clients are mostly inquisitive about. We do have some that do like to speculate, and we'll try to get into some of the altcoins that they've done their own research on. And those ones were, so for instance, Polkadot, for instance, when it came out, and XRP. The other day, my mother rang me up and asked me if Tron was a good investment. My mother's never spoken about cryptocurrencies at all, but that's starting to circulate within her elderly bingo circles. She doesn't play bingo, but but yeah. So to answer that question succinctly, Bitcoin, Ethereum, PaxG, and US dollar tether.
I'm going to echo something on that and say I've heard and seen so much attraction on the funding and yield side of things in the crypto market. I mean, just from the institutional point of view, a lot of people are looking at the space and saying, okay, cost of capital in crypto is just generally higher. Yield is pretty flat across the globe, right? So there's almost a way to take some level of crypto exposure by entering the kind of yield generation side of things, but without actually taking the full price risk of crypto. So I've actually found that very interesting. yeah, I just thought I'd echo that a little bit.
Definitely. And while we're on this topic, I would like to ask another question to Mark. This is something that was posted before our live stream started. Does the name of FF1 that you just mentioned imply that there will ever be an FF2? And what are the difference? Are they both institutional grade products? Yeah, and this is the question from Christian.
Yes, the fact that there's an FF1, it's that there's an FF2. In fact, we can talk about the FF2, which will release very soon. JJ just mentioned yield products, and if you want to speak the language of investors and capitalist investors, there's debt and equity, and most of New York distribution channels, but really the world over, is just sales channels of people that know how to sell equity risk and that know how to sell debt risk. And right now, as mentioned by both JJ and Trent, income is the new black. And if you have an income product specifically in fiat, then you're going to attract people. I mentioned fiat because yield farming in a numerare of your altcoin is not interesting. You're just giving me more altcoins. But yield in dollar now is interesting, or yield Bitcoin is interested because Bitcoin is liquid. So the yield in the numerare, either Bitcoin, ETH. So that's the whole DeFi thing. And so if FF1 was more of an equity approach, here's a lot of the price risk, as JJ mentioned. Some people do want that exposure on the price. Others prefer a pure income product. They just say, give me my money and give me a yield because I need income. And ironically, as JJ mentioned, what's happening with the volatility of the price is that if you know how to slice and dice volatility, either through futures or through options, you're able to turn that volatility by giving up some of that up price action, but guaranteeing an income by being senior on the cash flow and basically taking the cash out on a monthly basis, and that's your liquidity window. Now, that kind of income product is very interesting. It redefines banking, as a matter of fact, if you think about it 2 seconds. But it's saying, if God gave us lemons in the volatility of Bitcoin, do we have ways of turning it into yield? And the truth is that that's what I did personally with options on the public markets in 08, but with the language of options as opposed to futures, as we're seeing now. So FF2 is going to be that debt yield product, or that's what we have in place as flurry funds kind of things. That's how I placed my own money. But now we want to turn that into a product for guys like me who want to do this cleanly. And this is a yield product, so a DeFi-linked product. We're trying to define, not to make a bad pun, but DeFi today means a lot of things. But here we're talking about, the trading the price cap, the price action for some yield, and basically offering a debt-like product, which people know how to consume. And I'll finish with this. In fact, the crypto nature of the treasury is not necessarily a positive. And when they go like, oh, you're giving me 8% APY, that's great, how you do it. And if you go anywhere near crypto, most people will go like, whoa, no, that's way too speculative, get the fuck. I mean, I've had people close the door in my face as soon as we say, the sausage, the treasury sausage is made this way. So let's keep that in mind. But I think the crypto field in general has matured. That's definitely how I am approaching it for my own funds. So I'm comfortable that there's an equity profile, there's a debt profile. It's synthetic. It's it's highfalutin tech. There's not all the pieces are not there. We can talk about that. But for example, the derivatives volume on Deribit or Backed or CME, they're it's still early. Let's put it this way. For example, there's zero traffic in options. There's traffic in futures, but not in options. So there's zero liquidity there. They're still looking for a market maker, basically, or liquidity provider. FF1 was equity, FF2 is debt. We're also looking at NFTs, for example. Today I was talking to Vinay Gupta from Materium, and there's a lot of ideas on, how to do funding this way would be a great application of crypto, I think. So yeah, I'm always looking for how do you apply crypto to traditional finance. And turns out we've seen store of value with FF1. There's income with FF2. Is NFT a thing so that you can do like sneaker auctions and do it cleanly and efficiently? Those would be cool applications of crypto, I think. So FF2 Prime markets these products, and right now we have FF1, the flagship product we launched as a token. It's on Bithumb Korea. We'd love to be on Coinbase one day, but we've got to start small. And we went from 350 to like 470, 480 today, but we did so in a stable way. So FF1 is there a product that takes out some of that volatility that's inherent to crypto and smoothes out the ride for participants and provides liquidity continuously as a result? That's FF1. So we were overbacked, meaning completely liquid. It has performed well through the crisis, and so we proved a few things. And FF2 is a DeFi income product that's been put in place privately, and now we're productizing. Yeah.
Thank you, Mark. I think we already touched on that several times on this panel, but we have Bitcoin. We have multiple DeFi like yield tokens. We have NFTs sometimes in the future. So how do we actually bridge this to the traditional markets? What are the institutional protections that institutional investors need and want before they actually are ready to test the waters? Because like JJ mentioned that you custody your own funds with an exchange. That's probably not the case someone from a traditional market would agree to. So what is needed exactly? What type of custody? What else? Maybe it's something, for example, I know, Trent, that you're very big on the education side, and some of the activities you're doing there are remarkable. So like, what are your thoughts? What do we need here to actually bridge this gap that exists? And we all agree, possibly on this panel, that there is this gap. It's still there.
Yeah, if we're talking about custody, one of the interesting things that came out was from the Office of the Controller of Currency, which basically gave the green light to banks to provide digital asset services for their customers. Now, there was never any restriction in that previously, and you didn't really see sort of banks or custody institutions taking it up. But you saw, particularly in Europe and even in Korea, and I'm not too sure if JJ can speak more to that. I don't know much about Korea, but some of their biggest banks have been investigating and proceeding with custody of digital assets. In Germany, the same. Kraken was even just announced, I think it was yesterday or a few days ago, I remember seeing in the news. They got approved for their special purpose depository institution. And so they'll be one of the, and I guess what I liked about reading through the article was that they must maintain 100% reserves. So if there's a run of the bank, each client is withdrawn in full. So there's no need for FDIC insurance. But essentially bridging that gap between the traditional and digital spaces, which is having that traditional financial banking services, which is able to interact with the digital asset space. So from a custody perspective, I think there's going to probably be, if you're used to banking with, bricks and mortar financial institutions, and all of a sudden they start offering it up, then you don't really have to jump too far over the fence to start playing in the digital space. I think COVID has certainly increased the speed and the need for further investigation into digital assets from high net worth family offices, institutions. And so a lot of that, the institutional protections have been getting built out over the years. And I think there's, some really strong custodians already in place. Even Fidelity entered the space a few years ago as well. And so I think that in terms of, from a custody perspective, it's there at the moment. There are or traditional financial institutions that will be entering the space as well. There's already existing banks that are bridging that gap. So I think that that's probably one of the, from here on in, you're probably going to see let me just rewind. Security and safety of your assets is, what's key. So the insurances are there. That's been, some pretty comprehensive insurance as well on your assets. So I think just to wrap all that up, I think what's happening in the custody space for traditional investors is probably really promising.
Thank you, Mark and JJ. Like, in your opinion, what other protections, what other pieces of infrastructure are needed here to bridge the crypto versus like traditional industries gap?
I think it just needs to become at a similar or comparable level to what currently exists. Because right now, no one cares about custody of their dollars. No one cares about custody of their stocks. The majority of people probably don't even understand how their digital stock certificate is custodied when they buy it on Fidelity or E-Trade, right? So it's kind of like, oh, I have this magical trust that this institution I'm with is protecting this asset. And right, and that's maybe more from a retail perspective from the institution, but I would even say for most high net worths and most family offices, I don't think the majority of them are really looking into how the digital certificates are stored on exchange or from the exchange perspective. So and even when we look at like cash, right? I mean, everybody understands that the bank, and if this is where being nice, holds 5%. You give them $1 and all of a sudden now there's 5 cents on reserve and they do whatever they want with it. So I think this concept of like custody and the over obsession with it when it comes to crypto is relevant because it's so easy for it to disappear. But if you're looking at the benchmark is just a level of trust of something people are familiar and comfortable with. I would say that some of the solutions out there are probably, I don't know, maybe on par on a safety level, except the issue now is insurance is extremely expensive. And on the flip side of that, it's still not necessarily like super user friendly or understandable. And then you have a fewer points of failure, right? So I think that's where crypto can very easily go wrong. One wrong number and an address, and it's non-recoverable. So I think the attention to detail and the necessity for some of these things is significantly higher, right? If you send a Swift wire somewhere and you get a number wrong, the transaction can be reversed. It's just simply not the case on the blockchain. So I think custody is a very interesting conversation. I think there's a little bit of, I don't know, maybe a disconnect between what people expect and what the current markets currently exist with. Yeah, I don't know, that's my 2 cents.
And in your opinion, so we have different jurisdictions here. Mark is in the US, Trent is Australia, and JJ, I think you're in Singapore, if I know it correctly. And I'm currently in Vancouver. So it's interesting, we have like a lot of different jurisdictions. And I would just like to ask all of you, like, in your opinion, what are the difference? How do you see different jurisdictions approaching the regulations? Something that simplifies the investments like into digital assets and work with this type of assets for institutional investors. Where is it harder and where is it simpler? Who would like to start? Because I know that maybe in Asia, I think like because I know personally less about Asia, so maybe JJ, you can maybe just give us like the regulatory perspective of how it looks right now in Singapore, in Korea. Are these advanced markets or yeah? Yeah,
I mean just from the regulation standpoint, is that specifically what you're asking about? Yeah, so I mean, Korea specifically has released some very clear guidelines on what companies are going to be allowed to interact with any type of crypto. They've announced tax laws. All of these are planned out. You have about a year left to implement a lot of these. processes, certain licenses, certifications. So it's getting very clearly defined. I know Singapore has also been doing a lot to define the space and make things as clear as possible. Regulation is something that is just kind of coming. I think Asia's defining it very well. I think the US has this kind of funny black box of a couple companies that are magically allowed to do things. But to be honest, I'm not following global regulation that closely because I just operate specifically in the jurisdictions that I understand how to do things in.
Yeah.
And no, please.
Oh, sorry, I was just going to add on to that just in regards to Australia. In regards to regulations here, cryptocurrencies essentially, they're legal, they're treated as property. And they essentially, in 2017, Australian government basically came out just with the rise of the 2017 ICO craze, and specifically stated that Bitcoin was to be treated as property. So we incur capital gains tax on it unless you're trading on a day-to-day basis. The cryptocurrency exchanges here, they just have to register with AUSTRAC, which is the AML regulator. I'm originally from New Zealand, which is, I think, one of the 5 countries in the world that have no capital gains tax. So depending on who's watching this, I'll be moving back to New Zealand at some point. So I guess from pre-2017, there wasn't much sort of clarity around it. The regulators here in Australia are we're working very closely with the community to try and give really clear guidelines as to what needs to happen, particularly move towards the future. So yeah.
And what happens with the banks? How do banks approach this type of assets? Because it comes very close with regulation, because that's the reasons why a lot of players, traditional financial institutions, are not in this field at all. Mark, what is the situation with banks in the US for someone who wants to work with digital assets on an institutional level?
Well, I think Trent already mentioned the big bridge, which is that traditional banks have been okay to custody digital assets, and so that's a first step, and that's an important technical point. The whole custodianship of the funds, as JJ also mentioned, nobody cares how it's done; just make sure it's done. And we go through that arcana, but so I don't expect too much. I don't think the wave is going to reach every bank yet to get into crypto, but the next wave is here. After 2017, there is fresh liquidity in the institutional hedge funds, the shadow banks, as I like to call them, etc. But then, if the question is on banking itself, I think crypto holds many keys, no pun intended, to the future of banking on several levels. I'll start with monetary issuance. That is already happening with the Central Bank of China issuing a CBDC. I happen to know the architects because they use my software, which was open source software, to build their core open systems of banking. I didn't know that. I went to Beijing, and the core architect told me, Dr. Fleury, I want you to know that we've implemented the Central Bank of China on your software. I had no clue. It's open source. I love that bit. But they're ahead of the curve. The US has floated some ideas on using CBDCs. I think COVID has stressed the need for issuance done directly through the Fed ledgers, as opposed to the intermediation of the banking system. Specifically, when Orange Shitstain can withhold the checks to prove his signature. And that's about as much politics as I'll do today. But the central bank did play with the idea of directly issuing from the Fed to the commercial deposits bank account, meaning direct M2 monetary mass deposits. And that definitely redefines banking. China is ahead of the curve there. In terms of retail banking, then, and to skip commercial, because I think you're going to have a lot of banking getting to crypto as institutions get in. Some people may treat their treasury as such. We've seen the example, I think Trent mentioned MicroStrategies moving $500 million, just saying that's my new treasury now. But retail banking is also very interesting because, again, we can have a yield product for FF2, for example, and it yields 6%, 8%, 10%, depending on the environment. At a time when it's very hard to get real economic cash flow into a non-digital, into an asset-backed instrument, if you can do that trick fiat on fiat, you have something to say to retail banking. Now, we're far from FDIC insurance, et cetera, as Trent mentioned before. But to some extent, what fractional reserve banking has shown is that you can operate with about 5% of the liquidity compared to the asset holding in equity. And what that means in practical terms is that even today, the exchanges, if they so wanted, could become the new banks. In fact, Tether's has been mentioned here, and there's always been rumored that Tether was always the Bitfinex bank, or the bank account of Bitfinex on Tether. Because if you can custody your funds in the dollar realm, in the digital dollar realm, as opposed to the dollar banking system realm, well, then you're really leveraging what crypto is good for, which is a digital asset ledger that you can redeem anywhere in the world, and you can have you remove the traditional banking system, essentially. You optimize the traditional banking system. So that's coming, and that's very exciting. It's down the road, but even today, you could say that, for me, it was clear in 2017, the exchanges were the new banks. I can keep a Tether account and stay in that realm, which, you're in the crypto realm now. That's where the CBDCs play in. They understand they can do that, even though it's antinomian to the public blockchain, meaning they will want private blockchain. It's kind of missing the point. Blockchain and Bitcoin was born in the drug trade, period. True story, as you know, and Silk Road and whatnot. So the idea of a central bank owning a digital ledger is kind of nonsense, but from a crypto standpoint, from a keys management standpoint, but from a convenience and distribution and IT standpoint, it makes a lot of sense. And the CBDC of China is a foray in that new bank era. Blah, blah, blah. It's a great topic. We can go on for hours.
It's like a topic for a separate panel. Thank you, Mark. It also gives us some interesting insights into what's going to happen in the space next. And since we have about 10 more minutes, Trent, I would like to ask you next, in terms of institutional grade digital assets, and maybe also broader vision, because all these things are so interconnected. What's your vision? What's the next step of development for this industry? What should we expect?
Well, sure. So in terms of the future of digital assets for institutions and
for institutional investors, yeah, and family offices, but not only that, because it's bigger space and everything is interconnected.
Okay. Well, I mean, DeFi is certainly opening up. We're at, well, I guess what's happening in DeFi, what looks to be like a bubble forming with a whole bunch of meme pools with anonymous founders. But I don't mind bubbles because it essentially sets the railways or the tracks for real technological innovation. And so I think, in terms of what DeFi is going to be able to do in terms of loan money, being able to access credit markets, trade both financial and non-financial assets, invest in a managed fund. And it's definitely increasing a lot of the liquidity around, which there is so for instance, if we look at Australia, if you look at the different regions of Australia, there's a common theme around, so for instance, Sydney, a lot of high net worth individuals, family offices that are invested in mostly illiquid asset classes. Then when you come down to Melbourne and Tasmania, they tend to be more liquid. And so when new projects are raising capital, they tend to come to Melbourne and Tasmania. And so I think, although it's DeFi, it's already making huge waves in the liquidity space, because it's essentially incentivizing all the participants in a chain of a transaction, be it like a crypto to crypto exchange or borrowing and lending transaction. It removes a lot of that, those centralized intermediary layers of brokers and banks, and just creates sort of multilateral pools of liquidity. So I think that's sort of one of the really interesting things to come out. At the moment, our strategy hasn't really changed with our clients in terms of we aren't offering or providing anything within the DeFi space. We're looking at it. We're certainly interested in sort of tokenization as well, and fractional ownership. Delving more into that just from our own research purposes. But I definitely think DeFi and tokenization is definitely going to be big coming up. So yeah, that's what I'd say.
Thank you. And JJ, any closing words from you?
Specifically on where the industry is going, or just in general?
In general.
Your love life.
Based on our discussion today.
Yeah, I mean, in general, I think the space is growing, right? And I don't think anyone's really denying that. I try not to make any predictions on how the space is growing. I'm specifically not a long-only trader. I'm a long-short trader. I just believe that there is growth in the industry, and I think there's opportunity to be had being involved. And I think it's very fascinating. And I wish I knew where things were going to go, right? We all do. I just think it's a lot of fun, to be honest. I just think we have an awesome, fun road ahead of us. And I don't think anyone fully knows. Some people will be right and get it dead on and know exactly where we're going. I think for a lot of us, it's a great ride to be along. And it's really interesting to see what we're working on and how everything we're doing could potentially shape things for, I don't know, potentially hundreds of years to come.
Thank you. I think I already asked the questions that we had from the audience. There's one about when's Binance listing Zap, but I don't think we will be answering that today. Okay. Thank you so much, everyone, for joining us today for this panel. Thank you so much to Blockchain Center for organizing. And we'll see you on one of the next Thursdays on the blog.
Oh, brilliant. Thank you.
Bye.
Thank you, everyone.